The House of Representatives just raised the debt ceiling. This is soon to be on to the Senate and then to President Biden's desk. You would think that America avoiding its first default by just a couple of days would be a positive thing. Because after all, if we were to default, there would be a massive recession, up to 10 million job losses, so on and so forth. But the markets have been actually reacting very negatively to this news. Well, maybe we know why. And if you look under the surface of this market, it's alarming. The Nasdaq has rallied 15% in the last 10 weeks, but out of those last 10 weeks, only 2 weeks have you actually seen positive inflows to the Nasdaq. What does that mean? Well, we'll break it down here in this video. The technicals don't look so good. Deutsche Bank says there's going to be a wave of defaults coming the second half of 2023 leading into 2024, and you're going to get the highest default rate since the great financial crisis. If that was not bad enough, China is seeing another surge of COVID that could lead to 65 million cases per week by June, leading to fears of another prolonged lockdown. This is leading the Chinese stock market to now enter into a bear market after China was supposed to be the best emerging markets trade of 2023 due to them finally reopening after about 3 years. And let's not mention the US. The JOLT job openings just came out, and there is about 1.8 jobs available for every one person looking for a job. Over 10 million job openings are now available. This is much hotter than what the estimate was and where the Fed needs this number to be. So it looks like we're going to get more rate hikes. Ladies and gentlemen, let's dive into all of this information that you need to know. And first and foremost, the debt ceiling. Let's acknowledge that briefly because the debt ceiling was just passed in the House. It's going to be passed in the Senate. Then it's going to be on to President Biden. Markets are no longer reacting to this. Part of why the Nasdaq and the S&P have returned such incredible amounts recently is because of this. Is because people are like, hey, debt ceiling is going to get resolved. This is really not an issue. There was some anxiety for a minute, but markets already knew this was not a problem. So now this is kind of like a buy the rumor, sell the news kind of event. You're in the sell the news phase. And really, when you look at the indexes, they don't look very strong. Taking a look at the Nasdaq, historically speaking, every time the Nasdaq gets overbought on the weekly RSI, you fall. Last time this has happened was November of 2021. And that was the peak of the markets. You have never been this overbought on the weekly RSI in a very long time. And this is a very reliable indicator going back in history. Every time you get overbought on the weekly RSI, you come down. Some crashes are larger than others, but it always happens. Now, as I'm sure most or all of you guys have seen recently, AI has really driven this market higher. And without AI, there's no telling where the indexes would be, but we know for a fact they would be a lot lower than where they are right now, or even negative for 2023, whereas the Nasdaq has returned almost 20% in 2023 alone. This is because the top 5 or 10 stocks in the markets are packing all of the punch. These very large gainers that are hundreds of billions in market cap have been carrying the broad indexes. Taking a look at this chart, the top line is the Nasdaq. The bottom line is the ADL line. This gives you a sense of the market breadth. And the average stock has actually been declining on a pretty consistent basis, whereas the markets have been going higher. Typically, you want to see these two pretty much look the same. If they look the same, then you're seeing broad participation. And that is what more or less tells you you have a healthy market. So this market looks not so healthy right now. On top of that, if you look at the inflows and the outflows to the Nasdaq over the last 10 weeks, dating back to April 3rd, you have seen 2 weeks of inflows and 8 weeks of outflows. And that is this period right here. At the same time, the NASDAQ is up 15%. Why is this happening? Well, really, a stock going higher doesn't necessarily have to do with more people investing in that name. It just means the share price is going higher. And what I really mean by that is if more people are willing to buy the stock at a higher price than to sell the stock at a lower price, stocks can go higher even though there's less dollars going into the stocks. Kind of like if people FOMO into a stock, there might be the same $1 billion, for an example, that goes into a name, but if it's spread out and it's not all at once, you're not going to get that huge rally in the share price. But if within the course of a couple of weeks, you pile a bunch of money in and people want to keep buying the stock higher and higher and higher and higher, well, that's going to give you a much bigger move for the same dollar amount that was put into the stock in this comparison. So in all reality, you have not seen that many people investing additional funds in the NASDAQ this year, but the NASDAQ has seen one of the best and most aggressive recoveries from the lows. You would really like to see this heavily skewed towards the inflow side rather than the outflow side to signify a healthy rally at this moment in time. That's quite the opposite of what we're seeing. Now, if that's not bad enough, inflation is a major problem of the Fed, the number one problem to the Fed. And the JOLTS job openings for the month of April just came in at 10.1 million, meaning that for every sign that says help wanted in a Dollar General that is trying to hire one position, that means there's 10.1 million signs out there that are trying to hire people. It means there's a lot of job openings. You were expecting 9.2 million job openings. So you came in about 900,000 higher than the average estimate. And this is the first uptick, and especially the most dramatic uptick in JOLTS job openings that you have seen in the past 6 months. This means the Fed has definitively more work to do. OPEC, this is a funny one. OPEC, they are telling investors to watch out in a possible signal that OPEC Plus may cut production. And they basically cite that a lot of people are shorting oil right now. And this is one of those things where if you do see a big cut, oil going higher does two things. It leads to elevated inflation expectations. As people see the price of gasoline going higher, they tend to think inflation's going to last a long time, and oh boy, it might be coming back. And it just contributes to inflation actually going higher on a headline CPI basis. But it also feeds into everything. Oil, whether it's actually making a product or service, it touches everything. Everything gets distributed. So everything revolves around oil when all things are said and done. The price of oil eats into profit margins, bad for corporations, but it also raises inflation, bad for the Fed and bad for the markets. Now, if that was not bad enough, Deutsche Bank says a default wave is imminent and will peak in 2024. They say a wave of debt defaults by companies in the United States and Europe is imminent due to, in part, the fastest monetary tightening cycle in 15 years. Deutsche Bank said in its annual default study released on Wednesday. This is a study that's been going on for over 25 years. Deutsche expects default rates to peak in the fourth quarter of next year. It forecasts peak default rates to reach 9% for U.S. high-yield debt, 11.3% for U.S. loans, 4.4% for European high-yield bonds, and 7.3% for European loans. So they are forecasting America to be hit much harder in this recessionary environment than even other places like Europe, which tends to be the opposite. things tend to be better in America than the rest of the world. Not according to Deutsche Bank. This, as well as everything else we've talked about, is leading to a lot of weakness in the global markets. Now, you wouldn't realize this if you're invested in America, but besides America and Japan, a lot of indexes are falling like a rock right now, specifically China and the Hong Kong market. They touched bear market territory as China's recovery momentum fades. A technical bear market is obviously defined as a fall in prices of 20% below the recent highs. And China technically managed to stay right above bear market territory, but for the sake of this video, Chinese stocks are in a bear market. They are very close to being in a bear market. You're also seeing the markets really freaking out right now because nobody knows what the Fed is going to do. On Wednesday, you've seen the markets go from pricing in a rate hike in June by an over 65% probability now to a 65% probability of a pause. So now that the debt ceiling is out of the way, the main concern from investors is going to be data. It's going to be the next catalyst. You're no longer going to have this event, which is the debt ceiling and possible default. And in all reality, nobody expected a default. So it was kind of making economic data less worthy of a reaction in the markets. And if you think about it, nobody expected a default. Nobody expected big downside from the debt ceiling crisis. So it was just buying the market some time. Well, now markets are going to have to face the harsh reality that the data just doesn't look good. The data looks like the Fed's going to have to raise rates more than previously thought and be more aggressive than most people thought. The data shows that the American economy is also not doing so well, and inflation is remaining very sticky. And the topper of all of this is AI. NVIDIA and Marvel, these two names were the only names to raise guidance based off of AI in a substantial way. What you actually seen Wednesday in after hours and Wednesday in regular trading was a virtual collapse in AI companies. CRM dropped 6% after their earnings report. CrowdStrike dropped 12% after their earnings report. C3 AI dropped 9% in regular trading and then 22% in after hours based off of their report. NVIDIA dropped 5.5% in regular trading on Wednesday. And there's only a few names left that have really not fallen yet and really has not seen a big momentum decrease. And if you want to argue that AI is the future, well, I'm not going to take you up on that offer because I believe it is as well. But is it worthy of these valuations? Is it worthy of NVIDIA being a $1 trillion market cap company already? That's pricing in a lot of future growth, a lot of future expectations. Any hiccup there, and we're going to have a problem. And the markets, they're kind of taking a little bit of a breather from the AI trade, and the debt ceiling getting resolved might be the catalyst to send the markets lower. Ladies and gentlemen, that is going to do it in this wrap up of what is currently going on in this market. Hit the like button and subscribe to the channel if you made it to the end of this video. Thank you for watching, and I will see you in the next one.